Hi, this is Chris Brightman, CEO and CIO of Research Affiliates. Uh, Today, I'm going to share some of my thoughts about the recent banking crisis. And before I do so, or as I do so, I'm going to share some of my professional experience that informs my thoughts on this subject. And I'm going to go back really to my days at university. I had a summer internship at First Chicago Bank in 1982, during which time I had a couple of assignments, one of which was to develop a credit model for municipal bonds using a spreadsheet program called VisiCalc, and also an assignment to run the Bara system as a timeshare to the VAX computer in East Bay in San Francisco, and display and create reports for equity portfolio managers of their factor exposures in their portfolios. And the reason that's relevant, I'll come back to in a moment. When I graduated from university in 1983, the job market was just awful. Unemployment was at 10%. And while the recession had just about ended, I didn't know that at the time, and it certainly didn't feel that way when I was searching for a job. It was not a very promising job market, but I was fortunate enough to get a position at the controller of the currency as a bank examiner. And that was a fabulous initial job because they had a nice training program, and I went and visited many different banks and learned to examine all of the different functions of a bank. But one of the fun things that I did at that time was I utilized the new, we called it a luggable computer, compact computer the size of a large briefcase, to use a new spreadsheet program called Lotus 123 to model the investment and asset liability position of the banks that we examined. And when I had the occasion to share the Lotus 123 model that I was using with the investment department of the biggest bank that we examined, Maryland National Bank, as soon as the examination was over, they offered me a job at a considerable increase in pay relative to what the controller of the currency paid me. And so I moved to Baltimore, Maryland from the DC area, and began working for the bank in the investment department, but mostly doing asset and liability modeling, understanding the interest rate risk of the bank and how to hedge that, and how to fund it. One of the things we spent a lot of time on was doing securitization deals. We had a very fast growing credit card company called MBNA, and the growth in those assets far outstripped our ability to attract deposits. So we needed an alternative funding means, and that became the credit card securitization business. We securitized lots of things: auto loans, commercial loans, mortgage loans, and that all created the ability to understand and model how assets and liabilities changed in value with respect to changing financial conditions. At the time, I became somewhat frustrated with the inability of the bank's leadership, the chairman of the bank, the president of the bank, many of the executive vice presidents of the bank, to really comprehend the process of setting market prices and changing the assumed value of the loan books and the securities on the held for maturity in response to changing financial conditions. And worse yet, they didn't understand really how to evaluate risk. The understanding of management at the time was that if you look at the history of charge-offs, of loan losses for different categories of assets, those with the higher levels of historical charge-offs and loan losses were riskier assets, and those with the lower experience of losses were less risky assets. And I tried in vain to explain that no, actually our credit card book had probably the highest level of charge-offs and losses, but it wasn't very risky because it was easy to model and forecast those losses and to price for it. On the other hand, commercial real estate lending had among the very lowest loan losses, but those loans were very difficult to forecast the losses. They were very, very lumpy. When they came, they were huge, but most years you had close to zero. And so it's the dispersion of the losses, not the level of the losses, that really reflects the risk on the balance sheet. But the bank eventually had to be sold, and that was something that I had an opportunity to learn a lot about managing through a liquidity crisis, and I'll mention that, come back to that in a moment. Back in the days when I was a bank examiner, before I went to Maryland National Bank, I got a fun and interesting introduction to liquidity problems during the S&L crisis of the early 1990s. I remember waking up one morning to one of my colleagues banging on the door of my apartment and telling me I needed to hurry up and get changed because we needed to drive up to the Federal Reserve Bank in Baltimore, and hadn't I checked my answering machine. By the way, in those days, there were no cell phones. There weren't even voicemail. What there was a physical answering machine. And no, I hadn't checked that on Sunday night. So I had to hurry and get ready to drive up to the Fed. And there we all got parceled out to various state chartered savings and loans. And there were runs. People had watched on television that there were lines at savings and loans in Ohio, and then people got to be concerned about some of the savings and loans in Maryland. And so we had to go out and send examiners to all of these tiny little savings and loans. And let me kind of explain what those are, if not everybody is familiar with the old savings and loans, but they were basically special institutions, usually mutually owned rather than publicly traded, who basically took deposits and made mortgage loans. And the problem that occurred was that in the early 1980s and really through the mid and late 70s, interest rates had skyrocketed because we had an inflation problem. And the value of those mortgages had declined relative to deposits and the liabilities of those savings and loans. And they had negative equity on a mark-to-market basis. Not many people understood that very well back then, but I came to understand it. But nobody marked those things to market. And in fact, there was a kind of a rolling liquidity crisis for the entire savings and loan industry. There were, I think at the beginning of the decade, more than 3,000 savings and loans. And by the end of the decade, fully 1/3 of them, more than 1,000, had failed. And probably almost all of them had negative net worth as the rise in interest rates had reduced the value of all of those mortgage portfolios. But there wasn't the instantaneous transmission of information, and not even the people that ran those savings and loans really understood what was happening. And that gets back to my conversations with the leadership of Maryland National Bank. These were very distinguished, successful people from good families, born, born in the decade of the 1920s, maybe World War II veterans, learned banking in the 50s and the 60s when interest rates were regulated, and banks weren't even allowed to cross state lines. And when banks became deregulated by necessity because of the volatile inflation rates and high inflation of that period, none of these people had been trained or even understood how to measure and manage a volatile interest rate environment, and so they were good, well-meaning people, but just not competent to manage through that a period. And I recall one of the sage pieces of advice that my first manager at Maryland National Bank, Carol Hebel, told me early on in my career there, which is, Chris, if you need to be smart to run a bank, there's too much risk in the banking system. And that was a lesson that was a lesson that I took away. When we got into trouble with too many commercial mortgage loans at Maryland National Bank, we created a liquidity plan. That's what I spent the late 80s doing, was modeling out, building some systems to understand all of our deposits, all of our liabilities. And by this time, we owned multiple banks and savings and loans and even consumer finance companies. And we had to pull all of this data together and understand what all our liabilities were, how interest rate sensitive they were, what all of the assets were, all of the commercial loans and mortgage loans and investment securities, and how they react to changes in interest rates, but more importantly, how they react in accordance with credit ratings. And we created a model of going all the way to losing all credit ratings. I think we had about 12 different steps of various split ratings between the major credit rating agencies for the holding company and the separate Keefe, Bruyette, and Woods rankings for the banks and the deposits. And we went through almost all of those different stages of the liquidity plan, eventually deciding that selling the most important asset we had, which was the credit card subsidiary in Delaware called MBNA, to what was then, I believe, called Nations Bank. This had been NCNB, and today is Bank of America. And I needed to find different employment. So I called First Chicago, actually called a firm called Brinson Partners, and Brinson Partners had bought themselves out of First Chicago and became an investment management firm, employee-owned investment management firm. And luckily for me, I'd gotten an MBA and a CFA while I was in Baltimore, and the folks at Brinson Partners recalled me and had favorable impressions, and they had a number of open positions. So I flew to Chicago and ended up taking a job as a bond trader and a fixed income portfolio manager, where I put to use my skills modeling to model yield curves and trade derivatives and treasury securities and whatnot. And the sort of interesting observation was that after a time, we sold ourselves to Swiss Bank. Swiss Bank was one of the three big Swiss banks, the other two, of course, being UBS and Credit Suisse. And Swiss Bank bought us because they had a huge private bank and they should know something about investment management. And as they told us at the time of the acquisition, they really didn't know. They weren't experts at investment management, but we were. And they wanted our expertise to help manage their private bank assets. Not long after that deal closed, though, the perennially challenged UBS just kept getting itself into one mess after another. And after too many successive messes and too much risk in UBS, the great and good of Switzerland got together and arranged a merger between Swiss Bank and UBS. They kept the Swiss Bank name, but they installed they kept the UBS name, but they installed the Swiss Bank management team to run UBS. So fascinating that here we are again, and just last weekend, UBS and Credit Suisse were smushed together by the great and good of Switzerland, and now there's one large, systemically important Swiss bank. I've had the opportunity over the succeeding decades to experience a lot more about liquidity management, interest rate risk management, and generally the management of the global banking system by bank regulators. I had some fascinating experiences in the 2007, 2008 era. In fact, today's environment gives me flashbacks to that period. But I'm not going to continue with a description of my background. I'm going to share now some lessons that I've learned